Hello, everyone. Welcome back to the channel. We are very close to 200 subscribers, so if you could subscribe, that would be great. Today, I want to talk about why infinite banking is a scam, at least according to Dave Ramsay. um, I don't have or know how to do the fancy technology where we can play a video and have me talking while the video is running. So we are just going to, I'm going to include the link in the description below. Go check that video. It's 9 minutes and 16 seconds, and you can see Dave Ramsay's response to the infinite banking concept. Uh, and I've outlined here the main points that Dave has brought up, and we're going to talk about these one by one. So, without further ado, first of all, I need to address that I think a lot of Dave's negative advice about anything that is not his um, teachings, I guess, uh, are very negative, and the reason why. Okay, so let's look at Dave's advice, right? So we look at it. We've got, you know, say 80% of people, right? 80% of people are going to be able to fit in this corridor. This is Dave's advice. It's typically, saving $1,000 emergency fund, tackling debt, leverage is bad, only invest once you've paid off the debt, etc., etc. And then you've got this 20% above where, this advice isn't necessarily bad, but he doesn't recommend it because there is risk associated with it, or let's just go with unknowns, or, let's even say kind of mistakes can happen. All right. Now, he treats this area like it is the plague. And so, in this area, you're talking about leveraged investing, you're going to talk about infinite banking concept, you're going to be talking about, I don't know, really anything that's an alternative finance product. I'm assuming he would hate the velocity banking strategy, you name it. Now, I don't necessarily disagree with this logic, at least for the platform that Dave is talking about. His audience is not the individual who wants to be hyper vigilant with their finances. His audience is the typical individual that is just trying to get ahead. His advice will work again for everyone. Everyone will come out better than they otherwise would have without any advice. But of course, it's not going to bring you to the most optimal or the best position. It is just going to bring you better than you would have otherwise got on your own, essentially. So I have a hard time kind of crapping on Dave like a lot of videos do, because I actually really, really, really like Dave Ramsey's advice. I think it is phenomenal. I think saving $1,000 emergency fund is a good idea. I think tackling debt and paying off debt aggressively is a good idea. I think that buying a home when you're able to afford it, not necessarily under the parameters he sets, I think it's a good idea. All of these things I think are great ideas. My problem with it is that he doesn't acknowledge that some of these things are good. But the problem is that they can be bad. So, for example, if we look at leveraged investing, well, I don't really have to talk about the risks of that. We all know that there's risks associated with leveraged investing. So, if Dave Ramsey said, yeah, in certain instances, if you're really smart and you're wise with your decisions, leveraged investing can work. Well, what happens when you say that? Well, people go, well, I'm wise, I'm intelligent, I'm going to make this work. And then they over leverage themselves and get themselves into a crisis. With infinite banking, it's a long term strategy. So if you have somebody that likes to hop on things and hop off of things, it's just not going to work. And the same is true for alternative financing. So let's kind of move on from this and go and start talking about some of his points. Now, the first thing he brings up when the individual that calls in says, they brought up that this interesting concept known as the infinite banking concept. Dave Ramsey makes the claim that the advisor is selling a dividend. So, for those that are unaware, essentially the way the infinite banking process works is when you earn dollars, the idea is you put it into your infinite banking system, which is a whole life insurance policy. And then from this, you leverage it. You take out a loan to go and invest slash spend your money. The money that's earned from this will go back to pay the loan. And this infinite banking policy earns a dividend, not in the traditional sense, mind you, where typically a well structured IBC policy is earning roughly, at least in today's environments, say, 3.5 to 4.5% interest. Uh, so this is how this concept works. Now, here's the issue is that by saying that the advisor is selling only a dividend assumes that the infinite banking process is only reliant on this interest rate up here, which is simply not the case. It's certainly a important part of the infinite banking concept, the idea that you are able to get liquid safe returns on your money. Uh, um, that are far above, your typical kind of 1% or less bank account, checking account, savings account, and it carries tremendously low risk. So this is just a problem because really the infinite banking concept, infinite banking, is more about this process here than it is about these interest rates up here. So I think that's kind of the first thing. It's very disingenuous to say that it's selling a dividend because it's really not. It's just a kind of nice to have. So the second thing he says is that there is an issue. And by the way, I literally wrote these while I was watching the video. And so if they look like they're just scribbled down notes, it's well because they are. So he says that essentially um, this whole process does not make sense because uh, as a mutual insurance company, which in Canada I believe the only one is Equitable Life, but I could be wrong, and I'm sure one of the IBC practitioners will let me know, and please do if I'm wrong. But regardless, so there's mutual companies and then there's stock companies. So Equitable and Sun Life is a good example. Okay, so what Dave says is that a stock company, all right, the owners of the stock are you know general people, right? You, me, whoever. You don't have to own a policy in order to be a stockholder in Sun Life. And then Sun Life goes and sells their insurance to other people, which in turn derives a profit for Sun Life, which they then distribute as a dividend or growth in the share price. Okay. Well, with a mutual company, what ends up happening is, well, this is what Dave's claim is anyway, is that they sell to people. And wow, I can't spell tonight. They sell to people, and these people are the owners of Equitable, and thus when the profit goes back into Equitable, it's being paid to the people. And so it's just this kind of big infinity loop. And then, of course, you have costs of administration up here. And so his whole argument is it doesn't make any sense. Potentially, this would be true if the only thing Equitable sold, or a mutual company, I shouldn't really pick on Equitable, it's just I'm most familiar with them. It would be true if all the mutual insurance company sold was whole life insurance policy specifically for the purpose of infinite banking. But the truth of it is there is term insurance. There is investments. There is benefits. I mean, you name it. There's usually a whole host of services that these mutual insurance companies provide where these profits end up going into the big pot, which then get redistributed to the owners, which indeed the mutual company, it is the owner of the participating policies that are the owners. So I think that's just flat out wrong what he said completely. Um, but of course, you know, it is what it is, right? You're going to get a reoccurring trend that I think a lot of what he says was wrong. All right, let's place this back where we need it. Okay, so I have a little note here about a return of contribution, a refund of premiums. So life insurance dividends are treated differently. They are a preferentially taxed, and a portion of them, if not all of them, and maybe an accountant or someone who's very familiar with the life insurance industry can comment below. But I do believe that in Canada, just like in the States, a dividend, or at least a portion of it, is considered a return of contribution, meaning that the way it stays tax free is it's considered a refund of an overpayment of a premium, essentially, which is fine and dandy. All I care about is that the policy is indeed growing. Whatever they and the government want to call it, it is irrelevant to me. Okay, so the next thing is that he says, Dave Ramsay, that is, that, think about it. You can borrow money, but whose money are you borrowing? And you're paying interest on it? Something to that effect. I'm probably butchering it. But essentially, what he gets wrong is he says that you are borrowing your money, um, which is actually not true. So when you go ahead and you leverage your money up here in this part of this equation, this money is actually coming from the insurance company. Your funds don't leave, they continue to compound and grow. The insurance money actually uses your policy. I wish to give me a second. I'm just going to clean this up here. Uses your policy as collateral. And so if you don't pay back this loan, they just go and kind of take the money out of your policy. Now that's a very rudimentary explanation. It's a lot more complicating than that. However, this is how it works. It's no different really than kind of a house. You've got a bank, you've got your house, you've got the loan. Right. In fact, you could kind of do infinite banking with a home equity line of credit, but that's a topic for another video. Uh, however, um, yeah, so the money doesn't come from you, so you're not borrowing your own money. Your money continues to compound. And here's the critical thing that needs to be remembered. The insurance company is charging you simple interest, whereas your money here is growing at a compounding rate. So it's compounding. Essentially, in the first year, say you have $100 plus 3%, it's going to grow to $103, but now you're going to earn 3% on $103 rather than $100, which is going to be earning you more than $3, right? Um, so you actually have the benefit that way where over time, even if you're paying more interest rate, a higher interest rate on the loan, the amount of money you earn will exceed that. Now, that isn't ideal, of course, and there's ways to get around it, but to say that you're borrowing your own money and that borrowing money is a bad thing is wrong. Again, it has to go along with that kind of 80-20 rule where 20% of people are going to be more than fine in this kind of alternative space, compared to the 80% that are going to be in Dave's realm, right? So, um, you know, for 80% of people, he's absolutely right. Borrowing money is going to be a bad thing, because it's going to potentially put people at risk. Although I would say that infinite banking is the lowest risk way of borrowing money, but it is what it is. Alrighty. First thing, rather, the fourth thing is he says, infinite banking is old school life insurance. I don't know if this is necessarily true or not. I just know that I've been pitched a whole lot of whole life insurance. Being a business owner. And I can tell you, until I started seeking out high cash value life insurance, the only life insurances that I was being presented with were um, high death benefit insurances, which they're totally different structure, right? So perhaps maybe this comment is true, but it's certainly not what's happening today. um, so the next thing that Dave talks about is that cash values die with the policy, and that only the insurance company only pays the face value of the policy. So I actually drew up a little illustration, again with Equitable, because it's the most accessible illustrator that I have available to me. But essentially, let's look at this. So the premium total is $10,000. Now your required premium is 4,200 bucks. So if you paid if you wanted $250,000 of life insurance, it would cost you $4,200. And then ultimately, this would remain the same no matter what. You still earn a little bit of cash value, but nowhere near as much. And then, of course, you've got your essentially your extra payments, we'll call it. Every insurance company is different. And then the dividends here are used to purchase paid up additions, which allows you to purchase additional life insurance. So you see that your death benefit, your face value is 250,000, but in fact, your total insurance after the first year because of the paid up additions is $282,000. So this is where it gets really interesting. So if what Dave says is true, only the face value would be paid out. So that means 10 years down the road, if the face value is only 250 grand, according to Dave's logic, only $250,000 should be payable. However, that's not true. Nearly $600,000 is payable. What Dave does here, I think, is a play on words. So he's talking about this, the total death benefit. He's saying, well, only the death benefit will get paid. So you're right. On paper, only the death benefit will get paid. But the death benefit includes, or at least is more than the total cash value, right? So if you were to add the $250,000 and the $201,000, it is still lower than the death benefit. And this is true pretty much all the way up until the policy, I believe, reaches 100 years of age, which, let's be honest, most people are going to be dead by then. So the truth is, he's just wrong. The cash values don't necessarily die with the policy. They're included in the death benefit of the policy, and thus they get paid out, right? Actually, and more. The internal rate of return, when you factor it on the death benefit, is massive in these policies. A very, very decent investment indeed. Okay, the next sixth thing he says is that uh, infinite banking, whole life is one of the most expensive insurance products on the market. So I would tend to agree if all that you were looking for was insurance and you had a defined period of when you needed insurance. And remember, Dave's talking about this kind of 80% of people, right? And for that, I actually don't disagree. But because of this compounding nature of it, if properly structured, your policy is going to break even typically around the years 4 to 6. And then after that, your policy is actually going to be earning more than you deposited in, or at least the amount of money you have in the policy is going to exceed what you deposited into it. And so this is where it gets kind of interesting in that your actual cost of insurance after year 4 to 6 is negligible. It's nothing. You're actually earning money to have this policy. So it starts to become very, very, very cheap. But again, if all you're looking for is pure insurance, then certainly there are better ways to do it. You could simply do a uh, a whole life policy that does not have any cash values. Your costs would be significantly lower. Um, but of course, talk to a professional. I should also say that I'm not a financial advisor or a life insurance agent. I'm just an individual who likes personal finances. Okay, so another thing that he says is that low risk tolerance does not need to equal losing money. This is one of the biggest things that really drove me nuts about this video that he produced, is that the individual that called in initially said, I have a very low risk tolerance. So very low. I think it was very low. Maybe even if it was just low. Who really cares? Okay. The fact is, somebody who has a low risk tolerance typically does not want to lose money. Whole life insurance is one of the most stable investments. I call it an investment in this stance, because we're going to compare it to other investments. It's one of the most stable investments that exists in the marketplace. Um, the standard deviation is very, 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 very low. And this is because insurance companies operate and use what's known as smoothing. So, for example, you've got the stock market that goes up high one year, up low another year, down a little bit one year, up moderately the other year, say slightly down another year, and then has another decent year. So, you've got this effect of up, down, down, up, down you've got the idea. So what insurance companies do is on very big years, they basically pay out a smoothed effect so that you have average returns throughout the entire period of time. So over time, as the market fluctuates and is expected to earn more or is expected to earn less, this amount of money will either increase or decrease, but it typically takes, 5, 10, 15, 20 years before you're starting to see noticeable changes in the return on the policies. So it's very, very low, and it also allows you to react because of the reduced speed of how things move, right? And so, you know, I agree that low risk tolerance does not need to equal losing money. What I would consider losing money is parking cash in a 1% yielding savings account that's being, deteriorated by inflation. Now, admittedly, 3.5 to 4.5% interest in today's market is still getting eaten up by inflation, but I suspect these are going to be relatively temporary periods. At least I'm hoping. The average is um, well, at least far more than 1%. So even if inflation will always exceed this 3.5 to 4.5%, it's still better than this 1%. Now, I don't think it will, but that's neither here nor there. So, do I think infinite banking is a scam? No, I definitely don't. Do I think infinite banking could be used by everyone? Yes. Do I think everyone should um, use infinite banking? That's where, in my mind, things get a little bit dicey. I don't know if infinite banking is for everyone in the sense that everyone would get what they want out of it, and it's because humans are intrinsically flawed. Um, so I hope that helps. I know it was a rather long video. Let me know what you think in the comments below. Go watch Dave's video, and whether you agree or disagree, it's perfectly fine. I don't mind having the discussion, but when you comment, be ready for a discussion. Be ready for me to rebut your points and debate with you. And we can have a healthy, friendly debate, no problem, and it will be fun. So, everyone, I'll catch you in the next video.